Hi, everyone, and welcome back to the Wealth Clock with Steven Weinstock. I've been investing in real estate for over 20 years, starting with single family homes, scaling into multifamily properties, commercial assets, and eventually launching my own real estate investment fund. This podcast is brought to you by We Capital and the Goethals Capital Fund, where we buy properties in cash, we lock in deep discounts, eliminate the mortgage risk in the first year, and we refinance later on in order to scale. But this show is not about me. It's about operators, founders, and closers who are building real results in real time. Today's guest is Jesse Holsapple, the founder of Blue Mountain Capital, a national commercial mortgage brokerage specializing in private lending and hard money solutions. Jesse has built a reputation as the go-to resource for borrowers, brokers, and developers when traditional financing falls apart. From foreclosure bailouts to creative bridge loans, Jesse's team delivers speed, certainty, and smart capital solutions across the country. Jesse, welcome to the show.
Thanks for having me.
Okay, there was a lot in there as far as the intro. What is hard money? Let's just give a quick overview. Most of our audience probably knows. Some people might think a couple of guys in trench coats show up to your door with a suitcase. Explain to me what hard money is.
Sure. In the old days, it used to be just a napkin deal, equity return. Maybe somebody could do the work. The other person could come in and write the check. Perfect teamwork. Nowadays, that's a little bit more institutionalized. It's a little less strict in the bank, but people do still want to know their money's going into a good deal. Asset-based only still does exist in certain parts of the country as well, depending on your strategy with lower leverages, but not as strict as the bank, a little bit more streamlined.
Walk us through your story. Where did your career start? Did you have any jobs or anything before you got into real estate?
I did. So I was born and raised in Montana, was in the banking industry, got into mortgages, wanted something where I could build a book of business, but do mortgages too. A public company called Altisource was starting an origination arm for private debt. I applied to it, went well, did a bunch of fix and flip loans. Up until that point, I thought that only private lending was somebody on HGTV that was writing a check and checking on their investment. Turns out there's an entire ecosystem around this, and that really exploded from there for me. So I kind of stumbled into it.
Okay. You worked in the mortgage industry. You founded Blue Mountain Capital. How long were you in the industry before you went out on your own with Blue Mountain?
With mortgages in general or just private lending?
Let's hear both.
Sure. So just all encompassing probably the last 7 or 8 years, I worked my way up at the public company to run a retail division, took a VP position for a large private national brokerage before going off and starting Blue Mountain Capital. There's just a lot of deals that we know how to put together. I wanted to expand on that skill set and say no less and yes more often unless something is really falling apart and something can't be done. But I didn't want asset classes to hold us back from being able to help out.
So when you went out on your own, did you bring along a book of business? Did you start out fresh? Tell us about those early days of running your own shop.
A little bit of both. It's definitely been a learning experience. There's people aren't going to teach you how to run a company because they're potentially in turn creating competition. Why would they do that? Your book of business does typically belong to the CRM and the company that you were with previously. It's a rule of thumb across sales anywhere in any industry. So in part, did have some referral partners to create a new book of business. We had to hit the ground running to rebuild that book, which we were able to do.
What kind of situations or deals typically come to you after the banks say no?
Good question. I like to mention to folks that we look at paper loan requests, a lot of the stuff institutional capital wants that's really cookie cutter. We have competitive options for that. But I think what we've started to find and where we found a lot of traction was if somebody is in a position where they need to cross-collateralize other properties to minimize out-of-pocket expenses. Maybe somebody is in a foreclosure bailout, but they're a sub 50% loan to value, strong operator, just unfortunate circumstances. We have partnered up with a lot of even other commercial mortgage brokers that might not necessarily know how to put those back together. And we'll review it on our side before we entirely send it out to the market. Some of the people we think might be a good fit, but anything from the bottom to the top for situations.
And the riskier the deal, the interest rate or the fees go up, I would assume.
Yeah, granted, anybody wants to potentially do them. I have seen plenty of cash in refinances this year where folks might be at a lower leverage, but somebody wants it even lower to be able to get comfortable. Maybe we can swing that, but you will typically see a little bit higher on the points, a little bit higher on the rate for those riskier deal types. You're asking a lender to essentially bail you out of a risky situation.
So are these loans long term? Are they short term? I'm going to guess that they're short term. Are you selling off these loans? Are these balance sheet loans?
Yeah. So for us, we're primarily a brokerage. We do have some correspondent channels as well. One being a family office that can do things such as a rural, more hairier residential deal, but it's got the potential for the most institutional say no to. Permanent financing. Yeah. Well, we've got some stuff in there for some SBA and traditional. We've got plenty of DSCR in there as well. A lot of it is short term. That's our preference, but we can absolutely help out on that permanent financing side as well.
Got it. So just for the audience, you have, I guess, a Rolodex. You know what a Rolodex is, or you're too young for that?
No, I know what a Rolodex is.
Okay. So you have a Rolodex of, I'm going to call them investors. Some people will call them banks, insurance funds, family offices, high net worth individuals. And depending on their appetite for investment, your clients who come to you for a loan, depending on where they are, how hairy it is, you will present it to different sources of capital.
Correct. So yeah, that's exactly right. So we're working with high net worth individuals that are writing checks directly off their pocketbook, private debt funds, family offices, institutional capital, insurance. That's all correct. Not one size fits all. So we're not trying to be the brokerage that grabs something and just blasts it out to the ether. We have a back end system that we've created based on our own internal organic growth of these capital providers, where we know what they're looking for. So we might have a couple of conversations. We're not trying to have a ton of different ones and hope for the best.
So if someone comes to you for a loan, depending on the type of loan, you're bringing it to your investors, so to speak, family office or high net worth individual. Let's just say this is a 12-month loan to bail some landlord out of some deal. Obviously, you guys see an exit if you're going to underwrite the deal and actually lend on it. Who is servicing this loan during the 12-month phase or a 24-month phase? But this, specifically on a shorter loan, who's actually servicing this loan?
Typically, the lender we bring it to is off the balance sheet lender. It allows them to get a little bit more creative. It's their own capital. They can find those compensating factors and they'll hold on to that loan on their books for the remainder of their term.
And they're set up to, when I say service the loan, the monthly payments, dealing with escrows, escrow disbursements, potential inspections, etc. Are these investors, are these family offices set up for that?
Yep. So I think what you're talking about is not only the servicing, but the draw schedules for things like renovation and construction. Absolutely. Those are our preferred partners. They're the kind of folks that we want to bring deals to because we know they're going to be in good hands. Not necessarily focused on what the cheapest is. What we're focused on is, how well of a reflection are they going to be for us over the long term? Or are you going to be mad for the next 12 months that we even took you to X, Y, and Z lender for that servicing? So I think that's a great point to bring up, because that can absolutely affect our future business with those same people. And so being able to offer a home for that potential loan that can do all of the above is extremely important. So that's the majority of what we do. I don't think we've placed any loans to date where that's not the case.
Interesting. Okay, so I have a general question. So I'm not asking specifically for Blue Mountain. Maybe just share with us an industry standard. You're doing, let's say, a $2 million loan. You're charging 2 points up front. That's 2% of the loan as a fee, and say 10% interest-only payments for 12 months, and then maybe even a point on the way out. How does the split happen between the broker and the investor or the family office? Is the family office happy with the 10% and the broker is keeping the points? Is everybody sharing in everything? What's typical in the industry?
So the typical process in the industry is every lender typically has a maximum of what a broker can charge. It's usually never more than the lender themselves. They're the ones taking on the risk. You are a separate line item on the final settlement statement yourself. Your broker points are a separate line item typically on the term sheet as well, so that it's very transparent as to how much the lender is making. That 10% is the lender's 10%. We're never going to see a dime of that. unless for some reason we're going through a correspondent channel, we're servicing the debt, we're making sure they make their on-time payments. But from a brokerage perspective, we're entirely a separate fee.
Got it. Got it. Okay. So the broker is getting compensated, obviously, for doing some of the legwork, finding this client, this borrower, obviously having the wherewithal to have a network of investors to bring it to, and they get compensated in the form of, I guess, points, and it's a line item on the closing. Did I get that right?
Yep.
Okay. Tell us about some of your worst deals, let's say in the last 24 months, without giving too many specifics, something that was real hairy. Maybe it didn't work out, but tell me about something that really turned you off.
Yeah. So I would say most of our pipeline are hairy deals. We tend to like those because our need comes in a little bit higher. We're not just finding the clients and throwing it at a lender and hoping for the best. We're putting together an entire package with most, if not all, in some cases, the package that the underwriters will want to see anyways. I'm talking about the schedule of real estate, track record, scopes of work, what you spent, what you haven't, putting that together for the presentation. But then as soon as the term sheet's accepted, we're also going and we are playing processor all the way to close, making sure that we can tackle those hurdles before we see them or as they arrive. As far as some of the worst deals that I've seen, they've actually been this year as well. Really, it's folks coming in and winding up shopping their brokers that are helping them out. It causes lenders to see the same deal multiple times, which also causes them to not really take the deal that seriously. It hurts the borrower more than it hurts anybody else. If it's being shopped around like crazy, not many people want it, even if it was a good deal to begin with. But the worst experience was probably in the last couple of weeks. We had a closing fallout at the last minute. And it turns out that was a good thing. A totally separate lender was also working on a close at the exact same time that we didn't know about on the exact same deal for a first lien position. I don't want to get into legalities for that. That's a little bit too deep for us. I'm just thankful it didn't close. We had heard some things about really dotting our I's and crossing our T's, which we had been doing up until that point. But apparently the borrower had been trying to close two first liens at the exact same time with two totally different lenders.
Interesting. Very interesting. Two first liens. That there must have been some title company shenanigans, but I want to ask you details on that one. How fast can you close? Let's say you have an experienced borrower, somebody you've dealt with in the past. They've gone through a cycle. They come to you with, again, a hairy situation, but they have a light at the end of the tunnel and they explain it to you well. How fast can you close? They come to you January 1st. When can you close?
Probably by January 28th. Granted, everything's happening on time. And I think that's what you run into the most. You're waiting on the appraisal, but while the appraisal's being done, you're trying to check off the remaining of the underwriting checklist. So you're just waiting to tee up those numbers. Doesn't always happen like that. In some cases, we do have capital partners that can close in less than a week.
Interesting. The investors are underwriting the deal, underwriting the borrower as much as the broker for the most part, or are they doing it, or are they even more diligent? And the broker is obviously has a list of guidelines that this investor is willing to lend on. How intricate is the underwriting process from these investors?
It can be pretty intricate depending on what the loan program is going to be. It's going to be much deeper than what we have. There's a lot of lenders that even, for example, if we were to go out and pull a tri-merge credit report, we know that's a part of the requirement. Probably not going to be able to accept that. So we do leave that up to them. So we're not dinging that credit score twice. If it's a construction loan, you're looking at potentially environmental reports, feasibility studies that have to be done and paid for by the borrower. And then it gets a lot deeper when it comes to large commercial multifamily, retail, things of that nature. So it's both lender dependent, but it's also program dependent as well.
At Blue Mountain Capital, are you lending on all types of assets? Any assets
Correct.
you stay away from?
I wouldn't say there's anything we stay away from. I would have said office, but we absolutely took on some office recently. It was just in a really good position to do that. The market's starting to warm up a little bit further to that. Land would have been the other one, but we've taken on a lot of land as well. I think the best way to say that we would look at it is we will look at anything, but we're looking at it from a feasibility standpoint. What's your existing leverage if it's a refinance? What are your plans? Does this make sense for a lot of the folks that we work with on a regular basis? If it does, and it does make sense, we have a strong operator with plenty of liquidity coming into some of those certain projects. If we feel like it's going to be needed, even some of those more or less desirable asset types can find out.
So you're saying even with the right operator and the right liquidity, an investor or a lender will lend just because they're happy with this guy personally.
No, no, not. Let me clarify. So I think the best way to look at it from a forefront perspective is a couple of things. Where's the location is going to be a big one. What is the liquidity of the sponsor? What is the experience pertaining to what they're trying to do? For example, you mentioned $2 million earlier. If that was a 5+ unit multifamily property, someone wanted to rehab, but they've only ever renovated 3 single family homes around 300 grand with 50 grand in rehab. It's a pretty light rehab and it's a 1 to 4 unit. You have zero experience with 5+. What gives us confidence? Who's your general contractor in some cases? Do they have that experience? It's a little bit more detailed than that for sure.
Blue Mountain Capital is a national firm. Is there any place, any cities in America, in the USA, that you are not lending on? And if so, why?
Yeah. So that would typically be Alaska, the Dakotas, Nevada, and Arizona, and California. California, really, because you need the DRE broker license. We just don't do any business there to begin with. We haven't felt the need or the urgency to feel we need to go get that at the moment. If for any reason that changes in the future, we'll dive into that a bit further. Arizona's pretty similar. Mostly it's because a lot of our capital providers do not want to be in those places. Granted, a lot of them are in California. We just can't because of that DRE. But the Dakotas and Alaska, for sure, there's a lot of folks that don't go there. So we don't go there either.
Is that based on regulation or based on population and size?
I believe that has more so to do with the regulations. Utah, for example, you typically need a broker that's licensed in that state that can sponsor. And I think, don't quote me, but I think they need an office space. So you would need to have an actual sponsor there to do loans through. But if you have a capital provider that's all over the place in the United States, but they're not based anywhere close to Utah, that might not be a state that they want to approach.
Got it. What are your top 5 busy states?
Yeah, we got Colorado, we got Florida, we got Texas, Massachusetts, let's say Tennessee.
Yeah, Tennessee is a pretty hot state. I didn't hear New York in there. That's where I'm from. I'm from Brooklyn, New York. A lot of people are afraid of New York City. I myself am afraid to be investing in my hometown. In the 20 plus years I've been investing, I dabbled in New York City back in '05 and '06 and '07. I did well with appreciation and selling the property, but it was just a nightmare to be a landlord in my hometown. For most of my career, I focused on New Jersey, which is like a suburb of New York City, as some of us call it. And more recently, I've been buying garden style multifamily in Ohio and Kentucky. But yeah, I don't blame you for staying out of some markets. Definitely.
But New York is definitely a place that we'd like to do more of. We're not afraid of the states where a lot of people would like to stay away from, because just from our kind of niche perspective, there is quite an opportunity to be had if most people don't want to be there. Great to know that you're from New York. I was listening to a podcast actually yesterday where somebody was asking them is it a cash flow state? Does it even cash flow, or is it more of an equity play? And the person had responded with, it's more of an equity play. Over the long term, people are trying to get those loans at those 1.0 PS&R ratios, but not necessarily trying to cash flow off of anything. They're lucky if they can. Is there any truth to that? Would you say that's pretty accurate?
Yeah, New York is definitely not a cash flow investment. Now, let me just backtrack. When I said I'm afraid of New York, I'm afraid of being a landlord in New York. As far as being a first position lien holder, no, I don't know if I'd be too afraid. I just want to make sure the deal pencils in and I have a strong LTV. But I always say that in New York, you have to be very talented to do well. And I don't know, maybe I'm not that talented and I could own in the other 49 states. But New York is a special talent. There's a lot of regulatory. And when I say New York, I'm talking New York City. There's a lot of regulatory. There's a lot of different ways to skin the cat to make money. But you'll have people just on the simple end. You'll have somebody who will buy a $10 million building. They'll put down 40% and they're fine with breaking even every month for 7 years. But when they come out and sell the property at the right time of the cycle, that $10 million property could sell for $18 million. And they put down a lot of money. You have some investors who are putting down less and they're out of pocket 30, 40 grand a month on, let's say, a $10 million property. And they're fine with it because they know whenever they exit, they're making $5 million. So it's definitely a rich man's game. A lot of the money to be made in New York is on the development side, but being a landlord, it's very non-landlord friendly, a very tough city to do all kinds of business in, but especially the landlord.
That makes a lot more sense as to why. Okay.
Got it. Can you share a deal that I guess others walked away from? You took it on, but I'm going to guess that a lot of these deals others would walk away from since you're dealing with, I guess, bridge loans and these hairy loans. Am I correct on that?
Yeah. To give a little insight on that, sometimes a bank's credit box, if you're 5 points below a required credit score, they can't move on it. That doesn't take away from it being an amazing deal. You just don't fit that requirement, and doing a rapid rescore is not going to, maybe they just don't have the time for it, or they just don't let people do it. It can still be a great deal. But rung down from that, you have a lot of these institutional private lenders that are out there. But the reality is they want a lot of those really pretty deals still. That is where it started with a lot of those, where we still said no to quite a few people. What I really like to take on, and which we take on a lot of, I would say at this point, are the ones that institutional private lenders want to walk away from. Banks already definitely have. Maybe it'll be a great project after this very heavy renovation you have to do. For example, one that we're having a really tough time with, but we have finally landed one or two quotes on, is a property in Idaho. They are taking a 1915 historic building in McCall, Idaho, and they are renovating. The town is only about 4,000 people, great for tourists, lots of fancy steakhouses around. So it's a great place to be from a seasonality standpoint. They are taking a 3-story building, leaving the first story open just for events, hang out, whatever the case may be. Floors 2 and 3 are 9 units apiece. They're not 9 units, they're 9 bedrooms. It was a single family luxury home by the zoning standards. It was appraised that way. They're going to leave it there. They're not adding any additional square footage. They're not doing anything crazy or rezoning it. They're going to turn it into an Airbnb, which adds a whole nother layer to the hurdle. So now you got a super heavy rehab. So it's about 2.8 million for the as-is value, about 1.25 for the payoff. You've got another 3.4 million in heavy rehab to be done over the next 18 months. And you plan to hold it. So the banks all want that part. It's not been a problem to try to obtain some preliminary LOIs for the takeout. But what they don't want to do is any of the heavy rehab in a rural location for something that's going to be used as a short-term rental property. That is tough. But one of the borrowers is a really strong general contractor. They have plenty of real estate they can put up if they need to do a cross-collateral play. He's doing it at cost because he bought into the partnership for the refinance. That one is tough for sure. Separate deal we had was over in Florida, just to kind of give you an idea of the reach there. Any of the sales opportunities that were available disappeared, needed a refinance. It was going to be a big medical office type of play for development, for construction, medical office building in the Aventura area. Apparently the original lender ran out of liquidity and was having issues, couldn't do the draws. So the borrower panicked, went and got a short-term bridge loan from some of the dead business loans, went from lines of capital, working lines of capital, just to buy some time to find another lender. The problem was lender number 2 does really short bridge loans. Didn't have enough time to get out of it. Bam, they hit foreclosure, had to do a foreclosure bailout. They only have a concrete pad there. It's not off the ground, but the value was there, worth 45, 50 million, just to pay out for 20 million. Needs to just get out of that because they were trying to plan a sales date. We were able to land terms for that. That doesn't always happen, but that is the capabilities that we do have. If there is a way to get that done, we're a pretty good bet that we can help out.
Any trends or asset classes that you're particularly excited about these days?
I would say multifamily. Multifamily, still single family, but who isn't on those? Yeah, probably anything in the residential space.
Yeah, it seems though, when you say single family, do you mean 1 to 4s?
Correct.
Yeah, it seems 1 to 4s are always, in my opinion, the safest real estate asset class out there. And specifically, you have on the exit, you have 2 pools of buyers. You have an investor who may buy it, or you have somebody who's willing to live inside. And obviously, interest rates affect everybody and everything. But when you have a 1 to 4, especially since the loans are typically not too large compared to a multifamily. It's easier to sell, in my opinion. Just again, there's more buyers out there. People who want to live in a certain place, in a certain house, may be willing to buy something where the math doesn't necessarily pencil in. While if you're an investor, everything has to pencil in on the bottom of that spreadsheet. So you definitely have more access. And yeah, the 1-4s are definitely the safest. There was a lender I was dealing with back in anywhere from 2018 to 2021. And I remember that first 2 months of COVID, emails went out from this company. We're only doing 1-4s. Everything else is on hold, the 5+, the flip, the this, the that. Only 1-4s. It's got to have 65% LTV. And they took a break on everything else. And it seems that a lot of lenders retreat into the 1-4 space because that is typically the safest asset class. What advice would you give to your younger self starting out in this business that you know today?
Man, that's a good question. I think I would just tell myself to prepare for scary scenarios, to always be there. The reason I say that is I was a person that if I didn't know something, and I'm still this way, I just dive into it. I spend a lot of my own personal time trying to learn the answers. I don't like saying I don't know if I can help it. And so I would dive deep into a lot of that. But I think what I thought the outcome would be is less scenarios that I couldn't figure out even quicker. I think you're just going to run into that constantly. Each new deal is going to be different. Like any sort of a construction loan, not everybody is building the exact same thing. It's a different set of blueprints. It's a different set of schematics, numbers, experience, and different hurdles as well. Just being mentally prepared for that. I think I could have left out a lot of frustration, but I think that came with time.
What's your take on AI and prop tech and other innovations in real estate finance? I know AI is the hot topic everywhere and everything. Seeing a lot of it on LinkedIn. In terms of real estate, what's your take on AI? And are you using it? Are you really using it? Are you just using ChatGPT to help you make your emails sound better? Are you underwriting? Are you scouting? Tell me about your tech.
I will absolutely use ChatGPT to help me put my thoughts on paper a bit better rather than using a pen and paper at this point. There's a certain way we like to present it to hit these check boxes when we send stuff out. And I don't want it to be overwhelming, but I don't want it to be too short. I don't want to miss anything. Big fan of the bullet point formats for categories, character, property. I really want you to understand to be able to ingest it pretty quickly when you see it without searching through the supporting docs. That has come in extremely helpful. One thing that I have been watching is folks trying to come out with something to help with underwriting guidelines. I really do think the first places where that might hit first would be banks or government-backed loans in general, because they are a strict credit box. Pretty straightforward. Either you check the box or you don't. I think for bridge lending, that's going to be one of the last ones to go for to more of the, I'm thinking in my head more of the debt funds, more of the opportunistic lenders, more of the high net worth individuals or small family offices that deploy a lot of capital for their investors because they can get creative with things. AI can't and doesn't know what your thoughts are on a case by case deal.
So I recently attended a real estate networking event in Manhattan. And the theme of this networking conference, it was a 2-day conference, was AI, how it's helping you, how it's not. And I was invited to speak on one of the panels over there. And on the panel, you had myself, a landlord, you had another very large landlord, real corporate style. And then you had 2 or 3 VC, venture capitalists involved in AI and the prop tech. And another guy was some sort of data scientist. And they wanted me on stage because they wanted to get the perspective from a smaller operator and how we're using this tech. And when I got up there, the answer or my opinion that I gave really floored the crowd. And what I basically said was, when I got on stage, I said that as a small operator, I'm using AI, but mostly ChatGPT, and I'm using it just to make my day and my chores a little easier. Whether it's putting together investor updates, I will use it as a first reference. So like you said, put your thoughts on paper. When I'm answering certain emails, I will use this. I'll also use it to, if I'm getting a contract or a large PDF, I will upload it to a ChatGPT and then I will ask it a bunch of questions, and I'll get, again, a first look instead of having to read all 36 pages of a PDF. And the consensus was that the real estate industry is 5 or 10 years behind on tech. And the reason that is because the real estate industry is so fragmented. It's not, the soft drink, the beverage industry, we have 3 or 4 big players and they lead the industry. With real estate, you could have 20% of the companies are large corporate behemoths with hundreds or thousands of employees where they could hire AI specialists and change everything internally and work it out. But then you have what 80% of the real estate industry could be 2 guys who are running an office with $150 million worth of assets. And these 2 guys could have been through 3 or 4 market cycles. They survived. They're obviously doing well financially. And it's very hard for some young guy to come in there and say, oh, we got to transform your entire office into AI, where, hey, we're a 3-man operation. We own 16 apartment buildings in the southeast. And you're going to tell me what I need to do in order to change it. It's more of a matter of I need to find some of these tools on my own and figure out a way how I could benefit. So I've seen lots of AI. I've seen a lot of proposals come my way, but a lot of it has to do with me changing too much of what I'm doing. When something simple like ChatGPT, as I'm using it, I'm realizing I could use it for more and more of my day-to-day. And when I started using it, I would use it for an email. And now I'm using it just more and more often. I guess that's why we're 5 or 10 years behind the curve. But the audience seemed to agree with me over there.
Yeah, no, I think that's hitting the nail on the head for sure. Fragmented is a great way to put it because it's so true. What if I go out and I claim to create the best thing for real estate and the real estate industry? The reality is I created the best thing for me and what I do and how we use it. If everything was so closely related and the same, people wouldn't need me for the kind of scenarios that we run into. Same would go for something on the AI perspective. If it was all so closely relatable and didn't have a wide enough gap and variations of what you need to succeed in that particular tranche, then yeah, I don't think we would be 5 to 10 years behind on AI. I think it'd be a lot closer to that.
You're working with a team of people at your company. How did you train them? Or are these people coming from a similar industry? Are you training people, from the start? Tell us about that.
Great question. So we have folks from no experience to 32 years in just primary owner occupied mortgages and residential, which tends to be an easier transition, I think, for some of the more paper loan requests like a DSCR. Pretty straightforward stuff. I am a huge fan of hands-on training because I can explain something to you all day long, but until you actually get those live scenarios and we can put that into practice and see those real life hurdles and see why one might be a DSCR loan for a purchase. The next one's the exact same thing, but they have 2 totally different sets of maybe some instances that we need to tackle as far as roadblocks. I'm really just talking at the wall at that point. And everyone that's come on board are both a go-getter, but they're extremely receptive. And I think those are the 2 things that make a successful LO in this particular business, because things change so much, it's easy to get a little bit frustrated or upset. I just did a loan like this, but it's totally different. Those live scenarios allow for a lot of hands-on training. I like to be a part of those deals from start to finish as much as I can.
Okay, Jesse, this was a fun conversation. We're going to wrap it up. Jesse, this has been really eye-opening to talk to you, so I really appreciate that. Before we wrap up, where can listeners find you? Where could they learn more about Blue Mountain Capital? Where could they connect with you directly? Go ahead. I'll also include this in the show notes.
Sure. I'll start with phone number. Easiest phone number to remember in the world, 719-250, all zeros after that. You'll get me directly. You can also find us on LinkedIn or the Blue Mountain Capital page there as well. Just search me up, Jesse Holsapple. I'm on there as much as a lot of people are on Instagram or Facebook. It is my social media outlet. To connect from there, you can always shoot me an email to scenario, JESSE at the color blue, MTN, capital with an or .net.
Thank you again for joining me on The Wealth Clock with Steven Weinstock. And thank you everyone for listening. Make sure to follow the show. We had a great time talking to company founder Jesse Holsapple from Blue Mountain Capital. Until the next time.